Welcome, everyone. For those of you who joined us last week, the 506B to 506C, you guys realized that was the first one we did, and I realized very quickly that I needed a co-host to help me manage all the stuff. And so I know there's a lot of you guys that offered to be the co-host, but I've got Bethany LaFlamme, who's many of you guys know her. She's our managing partner, probably knows more about funds than I do, actually. So if anybody should be doing this presentation, it's probably Bethany. But got her, that's going to be, hey, Mathieu. I'm going to have Bethany be my co-host. She's going to be letting people in, and then also going to be looking at the questions. And this time I also learned my lesson where we're going to make sure that when you have a question, you can just unmute yourself, because that's probably easier than me reading the question. But Bethany will call on your name, and my goal is to say it to everyone. So with that said, I just a couple of announcements. Obviously, again, Bethany's my co-host, but next week, Bethany's actually going to be hosting next week. So I'm actually going to be gone all week. I've got a mastermind up there in Sedona. And so I was trying to figure a way to make it happen on Wednesday, but it's not, and I want to be consistent. So we've got one of our amazing syndicators, Ashley Wilson from Bar Down Investments, who works with Jay Scott. And she's an amazing syndicator, and she's going to talk about her superpower, which is asset management. And so we'll make an announcement about that for the next one, but she is going to be teaching us all about how to maximize our properties with the asset management. So, so hopefully that'll be valuable to you guys. So, okay. So today, again, welcome everyone. Really appreciate you guys hanging around with almost 70 of you. And so today's topic is going to be funds. Can I get a heads up? I want to figure out, just for purposes of how much time I should spend on each, how many of you guys are interested in fund of funds? Just kind of raise your hand or just put something in the chat so I get an idea. Adam, I am. Great. Just let me know if you guys are interested in that, because then that'll tell me whether I should spend a little bit of time on that. Okay, a lot of people are interested in fund of funds. All right, so I'll split it up half. I usually like to just ramble for like 5-10 minutes on a topic, but I think this one's going to take a little bit longer. But then we'll go ahead and answer your question. So let's talk about funds first, right? We'll talk about a real estate fund, and then we'll go into funded funds, which obviously is kind of like a fund. But the way I see funds is there's actually 3 types of syndications that you can do, right? There's the project syndication, a project specific deal. There's a fund, and then there's what I call a hybrid. So we're all familiar with the project specific syndication, where you're actually find the property first, and then you raise the capital based on a specific game plan. I'm sorry, Bethany, I'm just getting a little distracted because your face is right in front of me, because and so I'm kind of seeing you, so it's a little distracting. Do you want to go dark? Do you want to just
Sure,
because that way it'll be a little bit distracting. There you go. That's thank you. So when I think of funds, I just think in general there's 3 types of syndications that we have. We have a project specific syndication, right, which is what most people start with, and that's finding the property first, getting in a contract, and then going to raise the money for that specific property. And so you're able to put together a very specific and detailed business plan where you talk about the asset, specifically the property, where it's located, what the game plan is. You can show the pretty pictures. You've got a pro forma. You have a game plan. Usually in our world, it's value add. So, hey, we're going to come in and we're going to, increase we're going to put some value add, increase the rents, increase the occupancy, NOI goes up, refinance, sell, whatever. But it's a very, very detailed plan. And the investors can actually look at your assumptions and can actually make a decision whether they want to invest in a very specific project. With a fund, it's the other way around, right? So with a fund, you actually raise the capital first, and then you go out and look for a particular property. And that looks very different, because at that point, there are no pretty pictures, right? There's no specific details about any particular property because you don't have a property. And so what we end up doing is something called a fund criteria. So, let's say you're in the multifamily space and you're going to go buy multifamily buildings in the, 50 to 100 range. Can you mute everyone, Bethany? If you're going to, let's make sure everybody's muted, because I'm hearing some, then I go muted actually. Yeah, Bethany, you know what? You can't really mute everyone, because when you mute everyone, you mute me. Bethany, why don't you make me the host again? I'm sorry. Let's just go there. I apologize, guys. This is the second one we've done. So Bethany, can you make me the host again so that we can try and figure out how to make the host again? And so with the fund, you don't actually have anything specific. So it's usually harder to raise money for a fund because the investors don't actually get to see what you're buying. And more importantly, they don't actually get to there we go. Sorry. They don't actually get to challenge your assumptions, right? So with the project specific, they're going to look at your assumptions, your pro forma, and they can say, look, this guy's or gal is out of their mind. There's no way they're going to get this kind of rent bump, or they're not going to be able to do this or do that. And so they actually have the luxury of challenging your assumptions. They can rewrite the assumptions, the underwriting, and then they can make their own decisions, whether it's still a good deal. With a fund, they're purely betting on you, making sure that they're going to trust you with their money. And so it becomes a little bit harder. But the business plan is going to be what we call fund criteria, right? So it's going to talk about generalities. And honestly, the less generalities you can get away with, the better. We've got some clients who have huge audiences. And so all they do is basically say, hey, we're raising money to go buy, mobile home parks in the United States. And that's good enough. But for most of us, we've got to give a little bit of details to the investors, but we don't want to tie ourselves too much. And so usually we're telling them the type of asset that we're buying, maybe the location, the size, the debt, the targeted return. So we're just giving them these criterias, and then the investor then contributes their capital, invest with you, really based on the trust that they have and the relationship they have with you. They're really betting on the horse instead of the jockey. So it's a completely different or a flip thing. Then the third type of syndication is really what I call the hybrid, which is actually also a fund where you raise the capital first. So the exact same thing as a fund, except you've already identified the first property, or maybe you've identified the first couple of properties. So you're raising money and you're giving a fund criteria, just like we talked about, that, hey, by the way, I've already identified property number one that fits this criteria. And then we give detailed, just like a project specific, here's the details of this property, where it's located, here are the pro formas. And then once we close this first property, we're going to go find another one and another one based on our fund criteria. So that's kind of, that's kind of the three basic syndications. And so with a fund, which is obviously the topic of this of today's discussion, the legal part is exactly the same. Right. So we're still going to create an LLC. We're going to still, most likely an LLC, maybe it's an LP, but most likely to be an LLC. We're still going to create a fund in the form of an LLC, and we still have to comply with all the regulations that you guys are aware of, and they're sick and tired of me talking about it, but it's the same old, right? You've got to register your syndication with the SEC, find an exemption, or it's illegal. So we've got to figure out whether we're doing a 506B or a 506C. All of that compliance is exactly the same. There's no magic compliance just for funds. So when you're putting together a fund, the first thing we're going to have to figure out is are we taking, are you advertising or not advertising? That's really the pivot points. And then more importantly, are you planning on taking non-accredited investors? Because if you do, then obviously we're going to have to do a 506B. Just get all these guys in here for a second. Bethany, you could probably show your face now. And so it's completely different. No, for some reason, you're still showing up as the main person, which is really distracting. So Bethany, you have to mute. So I'm sorry, you have to go dark again. So I appreciate you guys. This is the second one we've done. So it's going to be, we're still kind of got our training wheels on. So the difference then is it looks complete. It's the same exact thing from the compliance standpoint. That's where I was getting on. So all that same analysis is done. What's going to look very, very different, obviously, is the structure and your business plan, right? Because as we mentioned before, there's no pretty pictures, there's no pro formas, it's just the fund criteria. But more importantly, it makes it a little bit harder to do the structuring of the returns. For example, a lot of people that do funds tend to just give flat returns as opposed to an 80-20 split or a 70-30 or some hurdle. A lot of times it's going to be a straight, hey, I'm just going to pay you, my target is to give you 15% or 14%, and it's either a pref or, however we're going to do it. But that makes it a lot easier, especially if it's a fund that's going longer and longer. But the main structural differences, which is where we spend a lot of time in with funds, is on the structure, because there's things in a fund that you don't think about when you're doing a project specific, because you just don't have to do it. And so I wanted to go through a couple of those here. We've already talked about the business plan. The business plan is going to look completely different, right? It's literally going to be a section, still going to be a section on you guys, because it's very important for the investor to know what the syndicator, what the level of experience of the syndicator is. But there's going to be a section on, the asset class. Sometimes if it's a unique asset class, there'll be a section on, maybe the market that you're going into. But ultimately, the meat of it is just the fund criteria, just kind of those parameters that we talked about earlier. So the business plan is what's going to look very different. But then there's the following issues that I wanted to discuss, and I'll just kind of enumerate them, go through them. And if you've guys got specific questions, that's the whole point of today's presentation is to answer your specific questions. But one of the biggest issues that pop up is quite frankly, well, what happens if I raise the money in my fund and then it takes me a while to go deploy it, right? What do I have to do? Do I have to give the investors do I have to pay the investors some kind of a return while I'm holding the money? Can I just take soft commitments and not worry about it? And so there's no right or wrong answer. There's plenty of ways to do it. I would say that the most common way that most syndicators handle funds to handle that issue is they take a deposit, right? So we prepare all the offering docs just like everything else. There'll be the PPM and the business plan and the operating agreement, the subscription agreement, the stuff you guys know about. But the difference will be that instead of, let's say somebody subscribes for $100,000, instead of wiring you 100 grand, they would only wire you 10 grand. As a deposit. And so with the understanding that when you do need the money, when you do find a deal, you're going to do a cash call and you're going to request the remaining 90% of the money in a certain time frame, whether that's 5 days, 7 days, whatever you think is reasonable. You do the cash call fairly quickly. And so and then if they fail to do the cash call, they actually forfeit that 10%. So the idea is to get them in a hook, because if you do soft commitments, honestly, unless you're dealing with institutional money or maybe private equity groups or family offices, you always run the risk that a mom and pop investor, 4 months down the road, if you haven't done the cash call, hey, look, there's another shiny object came through and I decided to put the money somewhere else, or maybe there's a family emergency or something, but there's always an excuse. So you think you've raised, let's say you're trying to raise $2 million. You think you've got the 2 million, but it turns out you've only got 1.3 because you've lost a bunch of money. So that 10% is probably the way that most people handle it. Some people like to just kind of over raise, which again, some people like it, some people don't. But if you need 2 million, you can raise 2.2 and use that additional 200,000 to sort of cover the interest rate or the holding period during that 3, 4, 5, 6 month period. And then some people just say, look, tough, or hey, this is a great deal. And yeah, you may not make any money for the first 6 months because it's sitting in my account while I go find something. But at the end of the day, when you look at the whole 3, 4, 5 year period, it's going to be a great return. So don't worry about it. What's really important is the IRR or the ARR. So that's another way that a lot of clients have to do. But that's one of the issues we've got to discuss, right? Another issue that pops up is that you don't really think about when you're doing a project specific deal is the withdrawals. Are investors going to be able to just come in and out of your fund at will? Or once they come in, are they committed to staying in for 5, 7 years or 10 years or whatever your term of your fund is? We've got to think through those issues. And most of the time, investors don't want to be in forever and they want to know what the exit strategy is. So even though your fund might be evergreen or your fund might be a 10-year deal, they want to know when they get out. And so what we usually do is we create what I call little windows of opportunities for them to get out. And so, maybe they're in for a minimum of 2 years or 3 years. And then, once a year after that, they've got a window where they can give you notice that, hey, I'm ready to get out. I want to withdraw and get out of the deal. And they've got to give you a notice provision. Because if you just let people in and out of the fund at will, then your bookkeeper is probably going to shoot you. And it's just going to be a nightmare of trying to close the books every month. And so just create windows where you just open and close the books, once a year. And that gives you time, right? So they give you notice. And the way we draft these documents, we really give you guys a ton of time. So, there's a window, a notice window, and then you've got, another 6 months to get them the money, because obviously the last thing you want to do is have to do a fire sale and sell all your properties in order to satisfy the cash call. So that's another thing that you've got to think through is just how we were going to operate with these withdrawal mechanism. Sometimes people are concerned that, what if we do a withdrawal and 50% of the people want their money back. And so suddenly that creates a problem too. So a lot of times we'll limit the amount of withdrawals that we can do in any given year. Maybe it's 10% of the fund or 25% of the fund, so that if we have more people requesting withdrawals, they're going to be, we're going to shrink that to a maximum of 15% of the fund, and everybody's going to be able to take out pro rata that amount. So, but that's something else you want to think about. The term of the raise, most of our multifamily deals most of our deals are 5 to 7 years in general, but funds tend to be a little bit longer. Maybe some people like to do evergreen funds and 10 funds. So how long is this fund going to last? And are you just going to buy a bunch of properties at the beginning and then sell them all in 5 or 7 years? Or are you going to be buying and selling properties in and out and allowing investors to get in and out? So that's something else you want to think about. And I guess we already talked about the returns. So the fund structures. One of the things you want to be super careful about when you're doing a fund is any type of projection, right? Because Grant Cardone got into trouble with this. There was a class action lawsuit. Grant did a Reg A actually, which allowed him to, he registered the whole thing, but he was trying to promise or not promise. Oh, Grant, he uses the word guarantee too much. He ended up telling his investors that he was going to provide them with a 15% cash on, or 15% IRR or something like a 15% return basically, and 3x their money, but 15% of their money. And the SEC came back and said, well, you don't have anything. It's just a fund. There's nothing in it. You haven't bought anything. Where are you getting this 15% from? So he actually barred Grant from saying that he was going to return 15%. And then Grant went out and said it anyway in social media, which is what got him into trouble. So there was a class action lawsuit against him about that. So you just want to be really careful. My recommendation is if you're going to do a fund, it's probably safest. Well, it's usually safe in general to just take accredited investors only, because that gives you some more flexibility in terms of risk management. If things don't go the way you planned them, it's a lot harder for an accredited investor to come after you, because the SEC, right or wrong, assumes that they're sophisticated enough to should have known better. But if you are going to have, if you do have accrediteds only, I would just we like to use the word target. We're targeting 15% in our fund. But again, there's no assurances of that because you don't have anything yet. So you just got to be super careful about that. And so that's kind of the basics of the fund. Honestly, it's very similar structurally. You're just creating an LLC. It's not some magical, fund that we're creating. Maybe one other point I'll mention on funds. One of the decisions you're going to have to make is whether you're going to administrate this fund on your own or you're going to hire somebody to do that. In our experience, based on the size, most of our funds, they're larger than project specifics, but they're not huge. They're 20, 30, $50 million. And they typically just run those in-house. The sponsor will be the asset manager, but there is the option to go out and hire a fund administrator who can just handle, especially the all the withdrawals, people coming in and out, the reports and everything. But they just usually charge about, I think the going rate's about 2% of assets under management, which is really the reason why at least a lot of my clients stay away from it. But we have had a few that have done that. So, okay, I'll stop babbling there on the fun part, and I'll let you guys ask questions about that in a second. And let me just pivot then a little bit to the fund of funds, and then I'll open it up to the Q&A. Like I said, usually I want to spiel for about 10 or 15 minutes, but this one's going to be a longer topic. And so fund of funds is really a subsection of funds, right? So in a fund of funds, what you're doing is you're creating a fund just like you were at the beginning. You're raising all the capital ahead of time, and then you're going to go deploy that capital somewhere. But the difference is, instead of going out and buying real estate like we just talked about, you're going out and you're actually going to invest in other people's syndications as a limited partner. And so you're literally getting paid to go vet other sponsors, vet other deals, and then make a capital contribution. And you're basically a limited partner in somebody else's deal. That's what we call a fund of funds. Some people call it a sub-syndication. You can call it whatever you want, but it's part of the overall, it's a fund thing, but a lot more compliance pops up when you're doing a fund of funds. And so we go beyond just worrying about Reg D, Reg A, 506B, 506C, sort of that stuff, which is the raising of the capital. If you guys remember, or if you haven't, I usually talk about, there's always two parts to syndications. One is actually raising the capital, and then one is deploying it and acquiring something, right? And so raising the capital is 506B, 506C, all that fun stuff. And then usually we're buying real estate, and we don't need a license to go do that. And so usually we don't have any issues when you're raising money to go buy real estate. But when you're investing in other people's syndications, you're actually buying shares in a company. I mean, they're not shares, they're usually membership units in an LLC or maybe limited partnerships, but basically you're buying stock, right? So what you're doing is you're buying securities, and that's a very subtle difference. Even though that operator is then in turn going out and buying real estate, you're actually buying securities. And that's why this whole new world of compliance pops up. And there's basically, I think, 4 things you've got to worry about when you're doing fund of funds. And so I'll go briefly through that, and then I'll open it up to questions to see if, which one of all these points. So the first one, which is probably the most important, the first one is that you become an investment advisor. The way the SEC looks at it is you are sitting there advising your fund. You're advising your fund as to the purchase of securities, buying somebody else's LLC units. And so the SEC looks at you, or the securities world looks at you as an investment advisor. Now, that isn't necessarily the end of the world. The question then becomes, so what? What does that mean? Do I have to register anywhere as an investment advisor? And the answer to that depends on the states, because unless you've got $100 million under assets under management, which would be something that you would not consider, but have to register at the federal level at the SEC. Most of us that are doing these are not at the $100 million assets under management. We're raising 10, 20, 30, 40 million dollars to put in somebody else's deal or in a bunch of other people's deal. And so it becomes a state issue. And so what we have to do then is now go in, what state do you reside in? Where are you physically located? Where's your office? Where does your butt sit down? And that's where they're going to consider you advising your fund. Again, you're in the business of, you created a fund, now you're giving guidance and advice to your fund is to go buy something. And so depending on the state you're in, I think almost every state, there was one state that I found that didn't have an exemption, but most of them have some kind of an exemption that we can rely on. And it just depends on the state. Some states are very liberal. Kind of the one that pops always to mind, just because I've got a few clients have done it, is in Pennsylvania. Pennsylvania really doesn't care. As long as you don't hold yourself out to be an investment advisor to the public, and as long as you don't do more than 15 of these funded funds, they don't care, right? Then there's the other states that have a little bit of compliance, like Texas comes to mind. A lot of people, if you're from Texas, say hi in the chat there. Get some movement here. But I know we have a lot of clients from Texas, and a lot of people are from the great state of Texas. I used to live there, big fan. But in Texas, you are exempt from having to register as an investment advisor, but you are going to be limited to accredited investors only. So you are not allowed to do, you can do a 506B, but you can only accept accrediteds only. You won't be able to bring in non-accredited. And there is a form, sort of what we call a truncated ADV form, that you have to file with the Department of Securities in Texas. Not a huge deal. You can probably do that on your own. If you want to hire an attorney, you can do so. But that's another level of exemptions. And so a lot of them have that exemption of it's okay to do it, but you got to limit yourself to accrediteds only. And then there's the states that are kind of really out there that are no fun. So the state of Massachusetts comes to mind, because I've got couple clients, and if they're on the call here, that we try to look at in Massachusetts, and they have a requirement that, yeah, you're exempt, but it's a $2 million net worth, not a $1 million net worth, which usually kills any chance of doing that. And then the worst one so far I've come across is the great state of Washington, where, yeah, you're exempt, but you have to limit your investors to qualified investors, which means they've got $5 million in assets of investable assets to put in. So it really becomes prohibitive, and it's really, the exemptions are really, I think, are geared towards sort of hedge funds and stuff. And so if we're starting a fund, we just won't be able to do it in those states unless we actually register as an investment advisor, which again isn't the end of the world, but that comes with all of the regulatory compliance and the cost and everything. So if you're thinking of doing this for a while, it may be worth looking into. I did a deep dive into becoming an investment advisor through a Series 65, just because that's one of the ways you can become an accredited investor these days. And again, it's not the most difficult thing, but it's you got to take an exam. It's just the compliance and the cost and everything. But if you're serious about it and you live in the state of Washington, maybe it's worth registering there. So that's the first thing you've got to worry about, is you're an investment advisor. The next big thing you want to worry about is that you are really you're just a holding company. You're just a passive investment. You're an investment company. You're not operating. You're not doing anything. You're just holding capital and you're deploying it. And so the other issue that we want to make sure we avoid is we want to make sure we're not subject to the Investment Companies Act, of 1940, because that's another whole world of regulations you want no part of. So being an Investment Companies Act, having to register in the Investment Company Act is an absolute nightmare, and you want to, again, no part of that. And so the easiest way to get around that is what we call a 3C1 exception, which just means make sure you've got less than 100 investors, right? So if your fund has less than 100, so 99 investors, because the GP is going to count as one. And it gets tricky. So, I wouldn't cut it too close, because there's some look-through provisions. And so you may think you've only got 90, but it may turn out you've got over 100. But that's the easiest one. So as long as you've got less than 100, you're not going to have to register under the Investment Companies Act. But if you have a larger fund and you go over that 100, you want to make sure you're talking to your attorney, and just, if they're not bringing it up, then just making sure that's on your radar. And then the final thing that I wanted to talk, because I've already gone way over that I wanted to spiel about, is, you still got to worry about broker-dealer laws. I mean, one of the things that you cannot do is just create these fund-to-fund structures, just kind of as smoke and mirrors, so that you can avoid having to register as a broker-dealer. As we all know, because I've hit like a broken record on this, you cannot raise money for others without having a broker-dealer license. And so If all you're doing is, well, I'm going to raise a bunch of money and give it to this operator, and I'm going to create these structures, just really don't do anything other than just create a bunch of LLCs. That's going to look like what we call a disguised commission. I mean, if there's some additional compensation that's just basically ending up, that the operator is paying the fund, and it all just kind of goes all the way up to the syndicator, and that money goes in their pockets, and they haven't delivered any value, then that's going to start looking like a disguised commission. So we always want to make sure that we're actually adding value and, justifying your carried interest and your fees. What are you getting paid for? Because you still cannot get paid for raising capital. What you're usually getting paid for is, due diligence on the sponsor, due diligence on the property. You're going to fly down, you're going to get on a plane, you're going to go look at the deal. You're going to go meet with the sponsors. You're obviously, your investors are passive. They don't have time to go do that. So that's a huge value add. You're going to negotiate better terms for your investors. Like if you're coming in with $2, $3, $4 million, you're gonna negotiate better deals for your fund, right? Because it's less work for the operator, and so they're going to give you a discount on their fees or discount on their carried interest, and so that's a benefit to your investors. They might be actually getting a better return. Sometimes the minimum's really high, and so you coming in with maybe the minimums, it's a great investment, but minimum's 250. And you come in and your minimum's 50, well, great. This is an opportunity for your investors to get in that they otherwise wouldn't. But that's probably the number one reason why we do not do fund of funds that is one-to-one. And I'll wrap it up with this comment, and then I'll open it up to questions. And I don't know if my amazing co-host will be able to help me or not because of the way we're doing it. But the last point I'm going to make is we no longer do one-to-one because we just have a hard time justifying what you're getting compensated for. If all you're doing is saying, look, there's an operator, there's a syndicator out there that's raising a bunch of money, I'm going to go raise a piece of that for them, and I'm going to create my own fund, I'm going to raise money into my own fund, and then I'm going to turn around and invest it in somebody in that person's deal, then I don't think you have enough to justify that you're just not raising money for that person. What you ideally want to do, and the only way we do these fund of funds, is if you create your own blind fund. Meaning you're going to go raise a bunch of money. And then in addition to everything we just talked about, doing the due diligence, you're actually going to go find deals, more than one. And you're going to, first of all, obviously vet all the sponsors first, all the operators that you feel comfortable with. And then when they have a deal, you're going to look and do a deep dive and underwrite that deal and make a decision as to whether that's something you want to invest in or not for your investors. And then you make it an investment. And then not all of it, maybe 20% of your fund or 30% of your fund goes into that one. And then you go find another deal. And so what you're really getting paid for is really being like a fund manager, which is finding the right deals and allocating capital on behalf of your investors. And that's how you truly do a fund of funds via the blind pool. Now, it's not to say that it's impossible to do a one-to-one, but it becomes really, really difficult. The burden's going to be really high for you to show what are you really getting paid for, right? You better have airline tickets where you went down and did a due diligence trip. You better have, ideally, most of our clients will go meet with the sponsors in whatever city they are and spend 2 or 3 days meeting with them and meeting with their team and looking at their processes and operations. So it just becomes kind of difficult. So, all right. I apologize. I usually don't want to ramble for too long. I wanted to ramble for like 15 minutes, but this is a long topic. Maybe we need to break them up a little bit in the future. So I apologize. As I mentioned, this is only our second one. We're going to be doing these every week, different topic, always opening it up to Q&A. Bethany, do you want to pop in and just for those of you who weren't here last week, what I'd like to do is open it up for Q&A on this particular topic first. And then once we run through all of those questions, oh man, we've got 100 people on here. I thought there was going to be less people this week because it's a little bit more of a niche thing. But we'll get to all of them, I promise. I'll stick around as long as you guys need me to. But let's do them on the funds first. And then once we've exhausted those questions, then I'm happy to answer questions on any topic you want that I obviously feel comfortable being an expert in.
All right. Do you want me to just, here, I'll ask them for you so you don't have to scroll through. How about that?
Yeah, or if you, or just say the person's name and that person can unmute themselves.
Yeah, Drew Pitchford had a question about 1031.
Oh, Drew's everywhere. We just chit-chatted last, what was it, Drew, on Monday or something with Ken McElroy's happy hour?
Yeah, for Ken's happy hour, that's right. Yeah, and last week on this call too. So
you're a troublemaker, man. All right, what you got? What do you got?
Well, I mean, mine's kind of a simple one, but I guess I wanted to ask, can you 1031 into a fund? And I'm thinking more like via like a tick structure. Maybe is that possible, or is that just not a reality?
Great question. I'm not going to get into the whole 1031 structure. That might be a good topic for just a standalone topic. But as you mentioned, it is possible to 1031 into a syndication. But the only way to do that is obviously to create a tick structure, because it has to be a like-kind exchange. So whoever's relinquishing property over here, they have title to a property. They have to then take direct title to the current property. With a blind fund, they obviously can't come into your fund, so that's not going to work. But there are ways to kind of think about it where you can structure the fund to allow in your subsidiaries. Because think about it, when you do a fund, each property, let's say you're doing multifamily, each multifamily is probably going to be, not probably, will be in its own sub LLC, right? So that sub LLC, instead of owning 100% of the property, could own 80% of the property, right? Which is then owned by the fund. And then the other 20% would be owned by the 1031 person coming in. The challenge with that, and again, I said I wasn't going to get into it, but the challenge with that is that there's not really a challenge from a security standpoint, but the IRS has a bunch of regulations. I believe it's IRS regs 2002-20. Pretty sure that's what it is. And there's about 15 things that the IRS does not want you to do, or are, in terms of 1031s. Some of them, most of them don't matter, but the ones that really do is it really prohibits you from getting compensated on that, whatever that 10%, that tick number, because you have to distribute things proportionate to ownership. So you can't do a pref. You can't be like, well, you only own 10% of the property, but I'm going to give you an 8% pref and then a 50-50 until this and that, the other. Can't do that. You can pay your expenses, and then you've got to distribute. In my example, if a tick member has 20% ownership, the tick would get 20% of the profits. Your property LLC would get the other 80, which then would flow up to the fund. So it is possible. It gets a little bit trickier, but you could structure it in such a way to allow 1031s.
Okay, thanks.
Yeah.
There's a question from Justin Frank. I see Justin here in the front. Can you unmute yourself, Justin?
Yeah, sure. I think I had a couple. LLC preference for formation. Are you always a Delaware or a Wyoming individual? Or is there a reason to choose one or the other?
It doesn't really matter. I'm partial to Wyoming just because it's so easy. It's got the best asset, as good as Delaware and as good as Nevada. And I would argue sometimes even better. It's got some privacies. And so I prefer to set them up in Wyoming. But if you live in Delaware, I would set up in Delaware. If you want to really do it in Delaware, knock yourself out. I'm not going to be the only time Delaware becomes a pain for us is at the property level, because, let's say your property's in Texas and it made sense for us to set it up in Texas, but then the lender sometimes, not sometimes, a lot of times recently, for some reason over the last couple of years, have really become insistent on having Delaware actually be the borrower. And so they have to own the property, which is kind of silly because then you got to register it back in the state where the property is. But yeah, for the actual fund itself, the LLC, I would just create it in. It really doesn't matter, but I usually create them in Wyoming.
Well, I'm in Washington, so that's why I asked. So,
yeah. It really doesn't matter because you're so far removed from from an asset protection standpoint. So to me, it doesn't really matter too much.
Good deal.
We've
Thank
got
you.
a few folks asking about their specific states as it relates to investment advisory rules, and I assume what the restrictions are on raising capital there for a fund of funds. California and Florida are coming up.
I know California is, Bethany's done quite a few of these too, is it's not as hard as you would think. You would think California would be one of these prohibitive ones. It is accredited investors only, and there's a little bit more compliance. There's some forms that you have to file with the state, and I believe there's audited financials. So it's a little bit trickier, but it's not prohibitive. It's not one of these $2 million or $5 million deals. Florida, I don't know off the top of my head. If you guys want, we associate, if you've been a client of ours, you probably heard the term, I like people are raising their hands, Bethany. You've heard there's a great attorney, a friend of ours, Alex Davies, who really does specialize in investment advisory rules and broker dealer rules. So, he's much more of an expert than we are. And so we usually associate with him. He's got a great website. I always screw it up. So I'll send it out to you guys with the replay, but there's a website that he has. You know what? Maybe I'll look for it during the next question, but he's got a great website that literally lists all of the states. And it's a good starter. It's not end all be all. I mean, he hasn't updated that since about 2016, but it's at least a good idea that you can look at it and see your specific state and first cut. One of the things, it is a little outdated. For example, we have somebody in North Carolina, and North Carolina, that set his structure said there's no exemption. But then I went in there and found out that they had passed an exemption just about 2 years ago. So now there is actually, I think, a simple one for North Carolina. But let me look it up while you guys are going to the next question.
Okay, Brendan Leach has a question. Brendan, if you can unmute yourself.
Sorry, I'm just asking the same thing about the investment advisories for Idaho.
Yeah, so here it is, and I would probably put it in the chat, but I'm kind of on a separate computer. So the website is called Strictly Business Law Blog, strictlybusinesslawblog.com. That's and a lot of the attorneys actually rely on this website. And then if you go to the top right, there's a section called Guides, and that's where you'll find all 50 states under the State Investment Advisory registration. So Strictly Business Law Blog is our good friend Alex Davies, who's just a ton of knowledge there on the investment advisory, broker dealers, all that stuff.
The second piece of my question was, if you had someone with a Series 65 or a Series 7 that worked with you raising the fund of funds and like say has another job and he just decides to join on, would that satisfy the requirement?
Yeah, so it makes it easier. So that's a great question. So if you already are an investment advisor, meaning you've got a Series 7, Series 65, then you don't have to register. From a security standpoint, it's not an issue. What's going to be the issue is, I don't know what usually you're hanging your license under someone, whether it's another investment advisory firm or a broker dealer or something. So they may have their own rules and regulations because they may not want you to go do your own syndication. They want you to sell whatever they're selling, right? But from our perspective, you're going to be fine, because at that point you have registered as an investment advisor. You're presumably licensed under the state where you reside, and you're hanging your license under an investment advisory firm or a broker dealer. So you'll be covered there for that. So if you're in the state of Washington, good news, you're good to go.
Great. Okay. Jacob Garza has a question. Our friend Jacob.
Hey, Bethany. Hey, Mauricio.
Hey.
Hey, buddy, how you doing?
I'm fantastic. Hey, just a couple of questions here. Let's just say we close 2 properties with 60 investors on day 1. Day 30, we add 80 more investors. Do they participate in these 2 properties? And then 60 days later, or 30 days after that, we close on 3 more properties. Do the 60 investors participate in those? How does all this work?
Great question. And the beauty of this, and really, I always talk about the fun part of it, is you can structure it however you want, right? As long as it's all disclosed, right? I mean, my concern there would be, is this a fund of, no, this is not a fund of funds. This is just a regular fund. My concern there would be the fund of funds. You're probably going over 100, but no, that's one of the considerations we have to look at. Like, if this is a really long-term fund, one of the issues that pops up is, well, it's kind of unfair for, let's say Mauricio is the first investor, puts in 100 grand, and I'm putting on all the risk. And then 2 years later, you've already got all this thing up and running, and somebody else comes in 2 years later. Is it really fair for them to commit at 100 grand as well? So a lot of times when we have a really long fund, we end up re-evaluating or repricing the shares, the membership units, based on some formula, based on some net asset value. Because if the net asset value continues to go up, it's really unfair for somebody coming in later or really there's no incentive for me to come in early. I might as well wait. And so we usually we really reprice the shares. So maybe the first guy came in at 100 grand, $1,000 a share, but a year later it might be $1,200 a share. So that's why. But yeah, we've done it both ways. So most of the time they would participate in it all. The idea is that, hey, I'm a part of this fund, and the fund's going to ultimately own all 7 properties. I've lost track of how many properties you were buying, but let's say you buy 7 or 8 properties at the end of the day. Most of the time the investors will participate in all of it, but you could set it up in such a way, probably with the use of classes. And you and I, Jacob, have talked a lot about different, we've done deals where we had 4 or 5 classes, right? So you could have class A, for example, only participate in the profit and losses of buildings 1, 2, and 3. And then we can create class B, and they could, be part of buildings 5, 6, 7. And just the P&L for those properties could flow up. Makes it a little bit more complicated, but you could definitely do that. So it's just, again, as long as we're disclosing stuff, you can do pretty much anything you want other than pay money raisers and be an investment advisor.
Great. I got one more question.
Yeah.
And this is just being candid.
Yeah.
you know, a sponsor just starting out, it's not going to go buy a 300 unit apartment complex. He just can't do it. So the fund, what's a criteria, if you would, for a sponsor? What does a resume need to look like?
It's much harder, in my opinion, it's much harder to raise money for a fund, right? Because people, like you said, it's almost impossible for a first-time syndicator, but not completely possible. We have clients who, you know, this might be your first syndication, but you may have been doing this for a long time, you know, on your own, and you've got proof of concept. Or we've got clients who just have a huge following. They got a huge podcast, a huge YouTube channel, or whatever. And so they may not have any experience, but because they've got a huge following, it's not that hard for them to put together a fund and say, hey, by the way, guys, you know me as a flipper, or you know me as this, but I've got a fund going, and people are just going to, you know, invest the money. But yeah, generally speaking, it's not going to be something to do the first one, because if you can pull it off, it's great. But if you don't have the track record, it's not a legal thing. It's going to be hard logistically to have people give you $100,000 if you've never done one of these before, right? But there's nothing that prohibits you from doing it legally. It's just realistically, it's going to be tough to have somebody bet on the jockey when that jockey has zero experience, has never done it before.
All right. Thank you.
Thanks, Jacob. Good seeing you.
Thanks. Scott Long has been waiting patiently.
Thanks, Scott. Appreciate you, man.
I appreciate your show. So originally I was trying to do a fund, but it was hard to get my friends, family, and cousins all to get the money up together at a certain time frame. So I decided to acquire 5 properties. Once the 5th one is acquired, I want to give my friends and family opportunities to buy into it. So would it be as simple as kind of like selling shares, or do I still have to track the accredited and non-accredited investors?
So you're saying you're actually acquiring the properties yourself first in some kind of an entity, an LLC, and then after you've acquired them, you want to bring in people afterwards?
Yes, sir. Exactly.
Yeah. So there are some additional issues, but it's the same thing. You know, you've got to, again, register, find an exemption, or it's illegal. So what exemption are they going to come in? Is if it's a 506B, then great. You can bring in some of your friends and family who are non-accredited. The challenge becomes, and most people forget this, but under Reg D, especially 506B, one of the obligations is to provide your non-accredited investors with audited financials, right? And most of the time that's not an issue because it's a brand new company. We're just creating it. There are no financials, let alone audited financials. But if you create the LLC, buy the properties, you know, now you've kind of been operating. And so then the question becomes, if you do have non-accrediteds come in after the fact, do you have an obligation to provide them with audited financials? That's something we'd have to look at. And that would be my main concern. But putting that aside, let's just say everybody that comes in is accredited, so you don't have to give them audited financials. They probably still want to look at your financials, but they don't have to be audited. Then there's no difference. It's just your disclosures obviously look a little bit different because usually your disclosures are everything before you buy the property. So once you acquire the property, there may be some issues that you've discovered once you took over the property. There might be some skeletons in the closet that we may have to disclose that we wouldn't have known of before. But it's the same thing. Register, find an exemption. So it's going to be 506B, 506C, or maybe Reg A.
Okay, great. And this is kind of the follow-up question. I fully understand you get what you pay for. What would it? I guess could you maybe throw out like a budget number for like entry level? Like this is going to be 5 single family homes. It's not going to be 5 big multifamily. I'm a single family investor here in South Florida. Is there like a ballpark and like price point? Like if I said, hey Mauricio, can you take care of this turnkey? Like what type of like budget range could you give me?
Probably around 20. It's a little bit more expensive than a regular because there's a lot more upfront. Like we usually do a strategy. Those of you guys that worked with us, we do a strategy call where we do a deep dive and go through business plans really in detail and stuff. But with a fund, we do like 2 or 3 pre-strategy calls because, you know, again, it's the first time, like, you know, what kind of withdrawal mechanisms, what, you know, what's the structure. And so we end up doing a lot of work ahead of time before we even get to the point where we have a business plan. On a project specific, you guys know, you guys put your pitch decks together and, you know, we work on it, but it's, you know, you've got 80% of it done. With a fund, a lot of times, especially first time fund is like, you know, what do we do? And so we really do a lot of hand holding on the front end. So I would probably budget 20 grand. Maybe even 25 if you've got to then add the blue sky filing fees and all the, you know, maybe additional entities, especially if you've got a bunch of entities underneath. So it's somewhere between 20 and 25. It's not. And so that's why it doesn't make sense to do a fund for maybe even $1 million. I mean, if you're going to do a fund, you know, you're going to want to do 5, you know, 10, 15 million. Because again, you want to do a blind fund, right? You want to be able to raise enough capital so you can go invest in multiple deals, 3 or 4 deals. And so you probably want to raise at least, you know, $5 million is what I would probably recommend.
Okay, perfect. Appreciate it.
Yeah, of course. Thank you. Thanks, Scott.
Thank you. Lance Holton had a question. I don't know.
Yeah, can you hear me?
Yeah.
Hey, Lance, how you doing?
Hey, I'm just wondering, so my company's based out of Washington. And I was wondering if it would be easier to actually move that company out of the state rather than go through all the rigmarole if we wanted to do fund to fund in the future. You think that would be easier?
You're the one that would have to move. So yes, it would be easier, but you're the one that would have to move, not the LLC. It doesn't matter where you set up the LLC or where the
Okay.
even the principal place of business. Where are you physically located while you're advising your fund?
Well,
Um,
I'm now in Oregon, but my business, I just moved maybe 6 months ago. So the business is still located in the state of Washington.
Yeah, and I have had some people who live. I don't know if this is where you're going at. Is some people live on the border, and so they may live in one state and have an office in the other. So it's really where your office would be, I guess. So most of the time, it's where you live. But
Yeah.
if your office is across state lines, it's where are you physically located when you're advising your fund. So that's the state that's going to govern. So yes, if you could open up an office in a non-Washington state, and I don't know what the rules are in Oregon, but set up an office and then you're traveling there and you're there all day at the Oregon office making decisions in Oregon, and then you head home and then you're not working from home, then that most likely is going to be Oregon.
Okay, gotcha. Okay, perfect.
Bethany, do you see people with hands up?
Yep, and questions. So I'm,
right, cool.
I'm kind of trying to go in the order that in which they were received.
No, I appreciate you. This is so much better than last week. And I was like,
No problem. It looks like Dee Dee Stump has a couple of questions. I think you might have answered them, so I just want to make sure she doesn't have any more.
Hello, can you hear me?
Yeah. Hey, Didi, how are you?
Oh, I'm well. Thank you so much for doing this presentation. Have you heard of a group called TribeVest so that you can have friends and family and whomever invest? I don't understand it exactly.
I have not.
Okay.
I have not. It sounds like a crowdfunding platform, which means they're either 506c deals, Reg A deals, maybe regulated crowdfunding, but it sounds like a platform, but I haven't heard from them.
I think it is crowdfunding. I haven't really looked into crowdfunding. How does that play into at all this kind of raising funds?
It's just the exemption, so it's no different. So crowdfunding can either be, the regulated crowdfunding really is that new rule that actually really is crowdfunding, which not too many people use, but maybe this is what this is. They just recently raised the minimum. It used to be $1 million, which why it wouldn't really work for funds. They just raised that. I think it's 5 million, but I still haven't had anybody want to do it, or it's just a 506c. So but funds would be a good one to put on a crowdfunding platform under a 506c. Because with funds, usually they're larger amounts, and you want to add people that are not on your list. So putting on a crowdfunding platform may make sense. It just depends on the economics and how much the platform is charging you, and how good their how good their database is.
Okay, that does it.
Yeah, so thanks,
help.
Michael. Michael was saying that TribeVest manages investment clubs. Huh? There you go. So
Investment clubs. So that's just like groups that
that's a
raise
whole
money
different,
for other people.
That's a whole.
Okay.
That's a whole.
Everybody,
other world.
yeah, I'd say everybody has kind of a say.
Yeah. Yeah.
So if I'm looking to find people that or groups that are fund raisers that can be a part of my fund, do you have any advice on how to connect with other fund managers that can be a part of my fund?
Meaning having fund of funds go into your fund?
Right. So I can reach out to people and say, this is what I'm doing.
Yeah, just like anything else. I mean, it's just networking, right? I mean, just going into a lot of these conferences. I mean, there's a big conference this weekend, right? That, obviously we're probably not there, but there's a big conference, and that's where they congregate, or Zooms or whatever. But, and then if you're actually going to be the one creating a fund where you want to accept other funds, a couple suggestions there is you want to first anticipate that ahead of time, because you probably want to create different classes for your own syndication, so that you can say, for example, what we would do is basically what you're looking for is feeder funds, right? So if your fund is raising 5 million, you may want to have a class of shares. And again, I'm saying shares, but it's really membership units. You may want to have a class of shares that the minimum investment is $1 million. And then therefore it's really going to be fund of funds that come into that shares. And then you give preferential treatment, right? So if you're doing a 70-30 split and an 8% pref, maybe for class A, it's an 80-20 split, or maybe the acquisition fees less or whatever. That way you're encouraging people to come in. And again, it's going to be $1 million investment. It's most likely going to be another private equity fund or another real estate fund.
And how long does the fund stay open? Let's say we create a fund, and does it have a year to raise your money, or can you keep it open for 3 years, 4 years?
You can it's up to you, right? So you can structure these things however you want. The
Got it.
challenge, as I mentioned, the longer you go, you start having other issues. So for example, if you're
Right.
going to have a fund that accepts non-accredited investors, then the longer the fund goes, the more likely you're going to have to at some point provide them with audited financials. So there's an additional cost. And then again, most of the time, if you're going over a year and you're acquiring properties throughout the term, then again, you're probably having to introduce some kind of a repricing structure where at the end of the year, you figure out what the net asset value of the fund is, and then you're going to adjust the price so that somebody who comes in next year isn't paying $1,000 a share like everybody else, but they're paying 1,100 or 1,200. And there's a lot of, and we probably can figure it out. I mean, it's not that complicated of a formula. It's just, what's the value of the properties multiplied by, whatever, and you can come up with a formula. But yeah, you can keep it open. You can do an evergreen fund, right? Which means it's open all the time. There is no end date. Right. But then issue becomes, well, investors don't want that. They want to, what's the exit strategy for investors? You're going to have to manufacture exits. So that's where the withdrawals come in. So again, guys, you can do absolutely almost anything you want as long as we're upfront about and disclosing it. I always joke, you can take 99% of the profits if you want. That's totally legal. Nobody's going to invest in your deal, but you could do that as long as it's disclosed.
Okay. Thank you for your help.
Yeah, of course. Thank you, G.
Bye-bye.
All right, Chris Collins has a few questions that I think probably a lot of people do.
I was just going to ask one of them, but I'll jump in with both. But Mauricio, how you doing, man?
Good, buddy. How you doing?
Incredible.
Good to see you.
Thanks for putting this on. I appreciate it.
course.
My question, I wanted to understand, I must have just not quite clarified it. The one-to-one fund of funds was a no-go, but it sounded similar to what you were describing when you're like, oh, you bring together everyone and you invest in a syndication with another operator. And then I felt like when you described the one-to-one fund, you were kind of describing that. Can you just elaborate and help me to understand what that meant?
Yeah, I apologize. So a one-to-one fund would be, let's use you, Chris. So you're putting together a deal, right? And you're like, hey, Chris has in contract, he's raising $5 million. And I'm like, hey, I could raise $1 million and put it into Chris's deal. And so I go out there and I create my own LLC. I raise $1 million into my LLC, and I tell my investors, hey, I'm raising $1 million to go invest in Chris's deal, and that's all I do. Then the question becomes, what am I? I'm just raising money for you at that point, right? So that's my issue there. That it's going to be I'm just not comfortable that you're not acting as an unlicensed broker dealer. You've created these fancy structures of an LLC within an LLC and blah blah blah. Blah. But at the end of the day, what you're really doing is just raising money into your fund to put into. I'm putting money into your fund. What a true fund of fund is, forget Chris is around. Mauricio says, I'm going to go raise $10 million to go invest in multifamily. And so I raised $10 million. Then once I've got the money, or I've got some of the money, then I go looking for, hey, Chris, that Chris guy, we've got a really great relationship. Let me call him up and see if he's got anything. And I've already done due diligence on him, or maybe it's time for me to do really due diligence. Let me go fly. Let's have some lunch and coffee. Let me look at your operations. And now I'm actually vetting you. I'm vetting Bethany. I'm vetting Dee Dee. I'm vetting like all these different sponsors. And I raised 5 million, but I'm only going to give you 500 grand or $1 million. And then I'm going to go find another sponsor, give them $1 million or half, whatever I feel is prudent. So that's the difference. There are some people who do it. And, to be candid, I think we've lost clients who have wanted to do fund of funds ones-to-ones, and we've said no. And so they go find somebody who is willing to do it. And I just don't think the risk is worth it. Again, it's just part of this bigger, I'll give you my little editorial here. It's part of that bigger problem or bigger issue that people are trying to figure out. How do I get around these rules where I want to pay people to raise money for me? How do I do that? And so the fund of funds is one way that bring them as we've all talked about the co-GP, but they're not really doing anything. And so we're literally trying to make things up. And so this is just another way of trying to do that. I'm just concerned that, when things start going sideways, that's going to be an issue. And I just can't, I'm not saying I would never, I mean, again, you're specific, you may be able to wow me and say, look, here's what I did. And I definitely am earning my keep and I'm not getting paid to raise money. And, I've done all these things, maybe, but in general, I would want to have you raise a larger fund without anything specific, and then go find, go be a stock picker, essentially, go be a fund manager and go find opportunities for your passive investors. And that's what you're getting compensated for.
Does that change if you take your payment as simply asset managing your fund and you don't take any payment from the GP in that deal? Does that make sense what I'm asking?
It-
Like you're
it's
saying
not gonna-
the worry is that a GP pays you to raise capital, but if you're like, hey, I'm not taking any money from the GP, I'm making
Yeah,
my
no,
money.
yeah, it doesn't matter. I mean, that's a given. You know, the GP or nobody's paying you directly as a fund manager. That's a
Right.
no. That's not going to fly. We're talking about scenarios where essentially you're paying the fund some additional money somehow in the form of a better return or better carry or a discount on your carried interest. It means the fund gets more money, but ultimately that additional funds just kind of trickles up the org chart and ends up in your pocket. That starts to look like a disguised commission. And
Okay.
it's not black and white. I'm not saying it's an absolute no. It's just, I'm just not, and I'm pretty, although somebody the other day called me a conservative, I consider myself a little bit more aggressive and out there than most, but I just can't find myself, maybe it's a 50-50 at best. And I just don't feel comfortable, doing it. But if you want to roll the dice and you can find an attorney who does it, I'm not going to be mad at you.
Okay. Yeah. Thanks for breaking that down. I appreciate it.
Yeah, absolutely.
Chris, you had another question that's a good one that people have asked. So you want to go ahead and ask it?
Sure. My other question was, and it kind of goes a little bit out the window and how much you really need to raise to make a fund worth it. But my question was, can you take a fund with non-accredited investors and have it end up in a 506c deal, which I think ties into your webinar from last week, but I don't know how.
No, that's a great question because if I had another hour, I may have brought it into my presentation. But so that's a great question. So let's talk about that. The answer to your specific question is no, because if you're putting money into a 506c, well, I shouldn't say no, most likely no, because if you're raising money to put into a 506c, that means your fund needs to be an accredited investor, right? And most of the time, the way you prove that your fund is an accredited investor is that everybody in the fund, all the members are accredited. Right. And so if you've got a 506B and you're raising with non-accredited, then the entity is not going to be accredited. Right. So that's going to be a problem. Now, it is possible for you to have raised $50 million. And so now you have more than $5 million of assets, that you can invest. So maybe you get there that way. But generally speaking, the fund has to be accredited in order to invest in the 506C deal. The other interesting thing is the other way around, which is possible. So if the fund that you're investing, putting the money in is a 506B deal, so it does allow non-accrediteds, and you happen to be, your fund is a non-accredited, let's say you have 10 non-accredited investors in your fund. Well, those 10 there's going to be a look-through provision. So your 10 investors are going to count against the 35 of the person you're investing in. So it's not just one LLC, one investor, that's one non-accredited. They're going to look through that. So that's another thing that if you come in with 30 non-accrediteds and that's it, they're going to accept you as the fund, and they're going to be out of that 35. The one last thing I was going to mention is, and I just lost my train of thought, so give it to me. The other one is, it'll come back to me. It was one of the look through provisions. This is a tricky one. This is a really tricky one, actually. If you're doing a 506c deal, right, where all of your investors need to be accredited, but you're not accredited as a GP, that's not a problem, because one of the definitions of an accredited investor is if you're a part of the executive team, right? If you're the GP or the manager of the GP, or if you've got some executive role, then you're going to be considered, I think it's called a purchaser, right? So it's not technically an accredited investor, but it doesn't count against the 35, right? However, that's not going to fly on the fund of funds model. So if you're a 506c fund and you're non-accredited and you're trying to invest into a 506c fund, you're a member of that fund or GP in that fund, and you're not accredited. That's going to make for purposes of their fund, is going to make your fund a non-accredited investor. I don't know if that made sense enough, but it's a subtle difference. But because your only reason you're not technically an accredited investor, it's just, but you are an executive of the issuer. And so for your fund, you qualify so that it doesn't count against you, but you're not an executive at the fund level you're investing in. So you would be considered a non-accredited investor for that purpose, making your entire fund non-accredited for purposes of the 506c offering.
Gotcha. One thing you flew by, and I misheard. If you get your fund up to 5 million plus, does that make the whole fund accredited? Was that one of the new stipulations?
I'm sorry, something caught my eye in the chat. Say that one more time. I apologize, Chris.
Did you say that if you get your fund up to 5 million plus that the
Yeah.
whole fund can become accredited?
As long as the 5 million wasn't specifically raised for putting the money in the deal. So you can't go raise $5.5 million and say, well, I've got $5 million. So it has to be like, if the idea was, if you're a medical practice or whatever, right, and you're a bunch of doctors and you put together an investment fund, and that, you've got buildings or whatever, and you've already got $5 million in assets, and the LLC is going to be accredited no matter what the status of the members.
Okay, thanks.
I just saw Jeff's, that's what caught my eye. Jeff, great. You said the Investment Company Act of 1940 requires all investors to be a qualified investor to charge a management fee in a fund of funds. That's right. That's why I said at the beginning, you want no part of having to be an investment company. If you have to register as an investment company, like, you're severely limited as to what you can do, and this, there's fiduciary things. And so you want to be exempt from that. And that's where that 3C1, or if you go over, it's not the end of the world. It just means I can't rely on 3C1. We probably try and do a 3C7, or we're just trying to make it somehow operational. And that's it. But yeah, you're absolutely, I don't know why that caught my eye, Jeff. So, hey, Mark, that's good to see you, buddy. All right.
All right. Deami Myers Taylor's been super patient. Thank you
So much for being patient. You're muted there still, bud.
Oh,
I can't hear. I can't hear. Is he muted?
yeah, he's not, but I think it's just his
Oh,
mic.
there he is. Yeah, I see you here. Yeah, you're not muted, so I'm not sure why we can't hear you. Let's skip that. Let's do one more, and then we'll go back to Deami, since I know he's been.
Masood.
Yeah. Hey, Masood.
Can you unmute Masood?
Hi, yeah, sorry about that. How you doing, Mauricio?
Good, Masood. How are you?
Doing well, sir. Thank you. So the question was, sorry, hold on 1 second.
So hi, I'm his wife, and we both are we're both just starting new, and we're really interested in starting funds. So my primary question is, can I partner up with someone who already has an experience with funds, and be in a GP, and what skills can I bring to the table? Also, do I need to be accredited to be a part of GP?
Great question. We actually had a great discussion on LinkedIn, I think last week, on this topic. That's the best way. Actually, I think we were doing an SMC. Sorry, a real estate guys thing. Somebody asked that the best way for a first-time syndicator to get into the business is to find an experienced sponsor, and just go add value to that sponsor, and whatever, we kind of joke, you want to go hold their bags and, get them a cup of coffee or whatever it takes for you to be brought into their deal and learn from them, right? Because you've got no experience. So it's that catch-22. So there's absolutely nothing wrong. In fact, I would encourage you to find somebody that's done this before, be brought in as a GP. It's most of the ones I've seen, usually you're not going to start with a huge percentage. You're going to be a 3%, 5%, kind of a small percentage, but you're there to add value, right? So whatever skills set you have, whether it's underwriting or due diligence or boots on the ground or, managing investors or whatever it is that you're doing, that's the best way to learn, is to find somebody experienced and have somebody take you under their wing and give you a small percentage, 5%, maybe 3%, for you to do whatever it is you possibly, at that point, you're not in it necessarily for the money, you're in it for the experience. So you can absolutely do that. In fact, I would encourage it. And then whether you need to be an accredited investor or not, it depends. It shouldn't matter if you're a GP and you're actually a legitimate GP and you're actually doing work and you're an executive and you're a co-manager, which is what you should be, then you're going to qualify as an accredited, as a purchaser under the rules under 502, under 501. So that's going to be fine. The challenge again is if you're doing a fund of funds, that might blow, and you're trying to, and the fund is otherwise everybody else is accredited and you're not, you might turn that LLC into a non-accredited investor for the purposes of going into another fund. But assuming that's not an issue, that's the number one thing I would do. There's two things I actually recommend doing if you're starting off. One is to find a sponsor who's experienced, we just talked about. And the other one that people don't talk about too often is just to syndicate one of their own deals. Right? There's a lot less pressure. If you've got a piece of property out there that you already own, then you can raise, you can sell it to a syndication and raise the money and buy it from yourself. I mean, that's, again, you can just, obviously there's potential conflicts of interest, but there's a lot of benefits from that. I mean, the property really well, where all the skeletons are buried. And as long as you're disclosing that, and then that takes the pressure off because there's no pressure to get the thing closed. You control both sides of the deal. So if it's a first time syndicator, that's another model that you may want to look at. But finding a mentor is a great model that I would also highly encourage.
And I'll say we've got Ashley Wilson on here, who you're gonna all be hearing
Ashley!
next week. And I'll tell you, I listened to Ashley speak at the Bigger Pockets conference, and the best piece of advice she gave, at least on that panel, not the weekend, but on that panel, was when you're looking for mentors and you're looking for co-sponsors, lead with what you bring to the table rather than something you need help with. Tell them you've got a superpower. You're here. You're doing something awesome. Tell them what that is. You don't need to ask for help. Just tell them how you add value. That was a big piece of advice that Ashley gave. Sorry if I stole something you're going to say. Ashley.
Love it. Ashley's so amazing. And yeah, we talked about that too. It's all about adding value. So just, how do you add value to someone? And yeah, really looking forward for next week. Thanks for doing that, Ashley, to bring some massive value next week as well, and talk about, asset management and stuff. So I'm going to miss you in Sedona though. I was really excited to hang out with you and Kyle, but
you guys are making me blush over here.
No, we appreciate you, Ashley.
Just to add a little more color to that,
please.
I get approached all the time about people asking, how can I help? How can I help? But exactly what Bethany said, you just have to lead with value. The greatest thing about this business is every single person can bring value. If you're great at marketing, if you're, legal backgrounds, if you're a CPA, if you're good at operations, good at construction, every single business applies to the multifamily business. So lead with your strengths as opposed to saying, well, I don't know what I'm doing. This is my first time. Then it doesn't come across to someone who's experienced that you're going to add value to them. So lead with value and you will be able to find people who need your strengths.
Love it. 100%. And don't forget relationships too. I mean, you may have a relationship with you may be in a market that the sponsor, or maybe they even haven't thought about it. So you can approach the sponsor with some data and say, look, this is a great market. I've got relationships, and or even you've maybe found a deal, or maybe your boots on the ground, or you're willing to go travel. So whatever it takes, however you can add value. But I love that, Ashley, where actually don't come with how can I help you, but here's what I'm good at. I can really help you do ABC. And I think if you ask enough people around, you'll eventually find someone who's in need of that.
Awesome.
Thanks, Ashley.
Thanks, Ashley. All right, Gianni, can we hear you yet?
I don't know what's going on there. No, you try to come in on the phone too. So I did see a phone come in. I don't know what's going on, bud.
You want to type it in?
Yeah, you want to put it in the chat?
If you type it, I'll get to it.
Yeah, if you want to type it in, we can read it out. Sorry.
Yeah. Kevin Matthew Gowling had a question. I think you answered it about what do you recommend for beginners, project-based fund or hybrid?
Project-based. It's really difficult unless you've got a huge audience somehow. You've got a really successful podcast, or you're a YouTube star, or somehow it just becomes really difficult. Or you just happen to be in a really high net, you can get five people to write you $1 million check or something. It's just really hard. I would start with project specific. It's easier to sell. Again, it's a general rule. It doesn't mean that everybody should start with a project specific, but it's just really hard to do a blind fund and ask people to trust you with their money and not know where you're going to place it if you've never done it before.
And to clarify that, Mauricio, would that be, when you say the project base, if I have somebody that's going to be doing the heavy lifting, speaking to negotiating with the seller, building the team of contractors, et cetera, that's their responsibility. And I come in not solely raising the money, but that's the value I bring to them. Is that what you mean by would that be okay? When
I say project specific, I mean, you're going to find the property first, whether it's you by yourself or you with a co-sponsor, or, brought in as a co-GP. And let's talk about that too, before I forget about bringing somebody in late. But if you're going to be doing your own deal, you're going to go find a property first. With a project specific, you're getting in a contract first. And now it's like, oh crap, I got to close in 60, 90 days. I got to go raise X amount of dollars, but you've got a specific business plan for this specific asset. And that's what a project specific base is. And it's easier because the investors get to look at your assumptions. They get to challenge your assumptions. You're going to say, hey, rents are going to increase in this place 5% a year for the next 20 years. And you'd be like, you know what? I don't know. I don't think it's going to be 5. I think it's going to be 2. Or maybe you think you can raise, you can raise occupancy from 75 to 83. And you're like, yeah, so they can challenge some of the assumptions. On a blind fund, they can't challenge any of those assumptions because you haven't even bought anything. You just have a fund criteria. That's why it's challenging.
Awesome. Thank you for that.
Thanks, Kevin. Appreciate it.
Thank you. Ignacio, I think you already answered this one. I just want to make sure there's not still a question since I can't tell when they really came in. Regarding the holding time allowed. I don't know if you're still on, if you want to pipe in. Ignacio?
Yes, I was wondering what is the time allowed for fund to fund? Let's say you have $1 million came in and you're still looking for a property, you're still looking for a deal. How long can you hold that money? Due to, we have inflation, so investors kind of like to move quickly. So what's the time allowed when you get the money?
Again, it's up to you. I think it's good practice to put that in the documents. It's not uncommon to have a provision in the PPM that says, look, if I can't find anything in the next 6 months, then I'll return your capital or something to that effect. But if you want to tell them, hey, I've got a year or infinite, or it's whatever you let them know ahead of time. That's why it's so critical to have all these disclosure documents, PPMs, and what have you, so that, again, the investor goes in completely open. That's the whole point of the PPM, right? The whole point of a PPM is to provide the investor with all the information, right? All the disclosures, all the information that's material to them, so they can look at the information and make an intelligent decision whether they should invest in your deal or not. So if you disclose to them, hey, we're going to hold this indefinitely until we find a deal, they go into the deal knowing that, open-eyed, and that's the whole point of the PPM. So if you want to limit it, or the investor says, look, I'm not comfortable giving you my money and you hold it for 6 months without it being put into work, then maybe put some of that language in there that you're going to return monies if we can't find anything after 3 months, 6 months, whatever. Or, as we mentioned earlier, take a deposit. So instead of taking $100,000 from them, just take 10. Now, the counter argument of that is like, well, what are they going to do with the other 90 if they've got to really, liquidate it and give it to you within 4 days? But maybe you're worried about inflation. Maybe they put the 90% in precious metals, and then when you cash call them, it's easy to liquidate.
All right.
I just made that up. That's not advice.
Thank you.
Wait, Louis Duong was asking a question about qualified purchasers. It's a good one for fund of funds. You still on, Louis?
Yeah, I mean, that's just a qualified purchaser is someone that has $5 million in investable assets, which in most of our worlds, again, Bethany and I are in the mom and pop business. So most of our clients are raising, on a project specific, it's, $2, $5, $10 million. And on funds, it gets a little bit higher, but we rarely see more than a $30, $40 million fund. And so I don't think I've ever had a client that has a qualified purchaser as part of it, because that's just tough.
Brennan Palmer is asking, he wants to clarify, can accredited investors or non-accredited investors invest in funds of funds?
Yes, if it's structured, yes. So absolutely. Theoretically anyway, whether it's a good idea or not, or that's you got to do a risk assessment on that. But yeah, if you're you could do a fund, which is 506B, so you can bring up to 35, again, all the same regulations, up to 35 non-accredited investors. The issue is then if your fund is a non-accredited fund, then you're going to be limited to only being able to invest in other 506B deals, because you wouldn't qualify for 506C deals, right? So that's the challenge there if you take non-accredited in a fund of funds. But theoretically, you could do it.
Jeff Niemeyer, it looks like you were giving a little advice, but I think you still had a question, yeah?
Yeah. Although I got to refer to my notes because I've been taking a lot of notes.
Closed fund versus open fund, you're asking.
Yeah, I'm not worried about that one. I kind of want to go back to, and I think it's important for everybody here, where he's talking about the management fees with a fund. When you take a look at, like a hedge fund or any other funds, they charge that 220 rule, 2% management fee and a 20% carried interest. If you want to do a syndication or a fund where you're only charging carried interest, you don't have to worry about the investment advisor rules and the Series 65. The only time you have to worry about that is at the state level when you want to do the management fee. My question to you is, with these syndications, they always have these acquisition fees. And then of course you got the disposition fees and the management fees and all the other fees associated with it. And with a fund of funds specifically, the way you would make your money is doing a 2% management fee on the assets under management, and you'd be exempt if your state's in an exempt reporting advisor. But I always thought, isn't this acquisition fee like money just for putting the deal together? How is that different? How's a management fee versus the acquisition fee versus the carried interest? And each one of them's taxed different as well.
Yeah, I mean, the carried interest goes to the owner, right? Your carried interest is we usually do different classes of shares. So class A members, class B members. So the class B member would have the carried, and that to me is the sweat equity, right? That's really what you're doing this for. That's really where the money really comes in. To me, the management fee, the asset management fee is just to keep the lights on, right? And so it's just to you've got an office, staff, lights, all that stuff. You're not going to get rich off unless you're doing a huge fund, but even then you're not getting rich. And the acquisition fee is just another, it's just another fee, no different than sort of, you can call them whatever you want, acquisition fee, management fee, but it's just a fee that the manager's charging in a different mechanism. But it's, as you said, it's very common for people to charge acquisition fees. Now with a fund, it's very important. Well, in general, it's important that generally you don't want to charge an acquisition fee, again, based on the amount of money you've raised. You want to charge an acquisition fee based on the value of the asset you're acquiring. And so in a fund, that's what I would do. I would say every time I actually go and acquire a property, because in a fund, let's say you end up buying 5 properties. When you close on property number 1, you're going to get your acquisition fee base. And that's really meant for all the work, right, that you had to do. You had to do the due diligence. You had to go, I'd go fly to the property, find the property, put the team together, do the due diligence, talk to the lawyers, talk to the CPAs. All that work is work. And so theoretically, that's what that acquisition fee covers. And as you're doing 5 properties or how many property your fund's doing, then it's separate work. Every time you've got to go, your whole team has to fly down and do the due diligence and all that stuff. So each time you do it and close, you get compensated for all that work up front. The asset management fee is just the ongoing as you're, updating your investors and making sure everything's running properly, overseeing the property manager. But really the carried interest is where the sweat equity is really what you're in for. And that's really where the money gets made, right?
Yeah, that's where the money's made. But like you said, the asset management fee is where it keeps the lights on and keeps you in business. Why? Because if it's real estate, it might take a few years in order for you to start getting that carried interest.
The other fee that people use, which is I think it's totally reasonable too, is a refinance fee, right? Because again, when it's time to refinance, somebody's got to, find the lender. They've got to you've got to go through you guys know how hard it is to all the paperwork and the bureaucracy of getting a loan. And then you've got to, guarantee, or at least even if it's non-recourse, is bad boy carve out. So all that work, it's suddenly additional work to go get a refinance. And so, getting a 1% of the loan or 1.5%, again, whether it's reasonable or not, but as long as it's disclosed, and it's definitely common in the market. I obviously you don't want to fee things to death, right? People get turned off by that as well.
So to make money in a fund of funds, then you would be, the only way to legally do it is, like I said, to be a broker dealer or to be an investment advisor, is if you have a blind pool and you're investing in a bunch of other people's deals, not a one-to-one, but I'm investing. If I raise 10 million and I want to invest in 5 or 6 syndications, I'm going to be making my money on the management fee, which keeps the lights on. And then as those deals close and I exit out, then I also take advantage of the not the preferred equity, the carried interest, the carried interest after those deals close.
But the key is we're trying to avoid at least the perception that you're really just getting paid to raise money for somebody else, right? And so when you're in the business of doing the blind fund, you're actually picking, you're kind of like a stock picker, right? You're actually going and doing due diligence, all these, 20 different deals. And then of those 20, you say, well, I like this one, or, so that's what you're getting paid for. You're trying to think of it this way. You're trying to justify, what you're really trying to do is justify your fee. I'm not getting paid to raise money for this operator. I'm getting paid for all these other things. And when you're doing a blind fund, you're really getting paid for due diligence on the sponsor, due diligence on the asset, and then making that decision to allocate that money to a particular project.
Right. And the syndicator that's doing the real estate deal is making their money on the management fees, asset management fees, the
carried interest.
Yes, he's making all the money and the disposition fees and the selling, all of those.
Right.
But as a fund manager, if I'm raising money, I'm getting paid to do all the due diligence to find out which one of those deals are good deals and which one of those are bad deals.
Right. Right.
Correct.
Right.
One of the things that I always tell clients, Jeff, is that if you are coming in with a lot of dollars, and I think Mauricio alluded to this earlier, into a fund of funds and it's a blind pool, you can go negotiate with those syndicators better terms than they'd be given to anybody coming off the street, which is a huge value add for you because your investors couldn't go in and get a 12 pref when it's being offered as a 10 pref to someone coming in at 50 or 100,000. You come in for $1 million, you might be able to get a higher pref. You might be able to get a bigger
Right.
cut of the back end. And so you can take your fee from that delta, right? So you're offering whatever it is you're offering, you're getting little pieces here and there from each deal that you can negotiate better terms.
Yeah, you can get better terms and you can be potentially a co-GP with inside their syndication deal.
Yeah, we
so
didn't talk about
you-
that. That's one way to avoid sort of this funded funds issue too, is that if your fund is actually a co-GP and is actively involved in that deal, it's not really a fund of funds at that point because you're actually actively involved in that deal. So you're no longer passive. So that's another way, and not that that's necessarily the way people want to structure it, because again, the idea for most of these funds is, once I do all the work and write a check, they don't want to have to worry about it. Maybe you've negotiated, some reporting or some veto powers. It just depends on what. But that's another thing you're getting paid for. It, as Bethany pointed out, is that negotiating better terms for your investors. You're adding value to, again, you're not getting paid to raise money for somebody else. You're actually getting paid to add value to your investors, and you negotiating better terms for your fund, which in turn helps your investors get a better return. You should be entitled to get compensated for that. But great questions. Thank you, Jeff.
Thanks, Jeff. Mark Adarios. Hey, Mark, how you doing? It's good to see
Hey,
you.
Bethany, how are you? Good to see your face.
Good.
Hey guys, as I was thinking about this, it turns out there's kind of two sides to what we're doing. So we're doing office, just kind of a particular capital thing that's with office. Another commercial is that you have kind of future funding of potential tenant improvements and leasing commissions, large amounts of money that need to come in years 2, 3, depending on when your leases turn over. And so, so we have kind of two choices. One of them is to possibly just raise a side mezzanine fund that we can have a bucket of capital separate and apart from any syndications that we have, $5-10 million that's sitting there. And then whenever we have a deal, it just invests in our syndication separately with all the paperwork and everything. Or we do like I guess it's a delayed raise maybe, where we do it more as preferred equity, where we just where it's non-participatory, so it's more like a debt style coupon. It's a separate class, but we don't raise it initially. We just tell everybody, hey, down the line we're going to raise additional $2 million to cover TILCs in this class C. So I guess my question is two things. Do you guys have an opinion which might be better? And then in terms of the mezz fund investing in our own syndications, aside from disclosing, do you see any other issues of us investing in our own deals? Basically.
No, we're actually doing a deal right now where it's something similar, where there's the original raise to go buy the asset, and then there's some additional capital that's required in the future. And they've actually done it both ways, right? So they were actually doing a separate syndication, raising capital separately to then get that money and use it for the project. And then this time around, we decided to just put it all in the same offering. And so like you said, it's a delayed offering. We're raising X amount of dollars, but we've told everyone that there's an additional $5 million that's going to be debt, and that's going to look like this, but we're not going to need that for a couple of years. Now, again, you have the issue of making sure most likely those guys have to be accredited only, because if they're non-accredited, again, you may have that obligation to provide them with audited financials 2 years down the line, because now you've got an operating business for the last 2 years. So keep that in mind. But no, we've done a lot of these debt funds or lending funds or whatever, where you raise capital into an LLC, kind of like the bank, and then you lend that money to yourself or your syndication. Right. And as long as it's all disclosed. Now with lending, maybe the only caveat I would give you is, depending on the state that you reside, you just want to check with your real estate attorney or transactional attorney, make sure there aren't any lending laws. Like California is just, notorious now. I think it was 2019. They just passed a whole new California lending laws, which make it like a nightmare to lend money in California, not surprisingly. So whatever state, and again, that's not my area of expertise. So sometimes it's like not necessarily where the loans are happening, but it might be where the entity is located on that one. But just check with your real estate attorney to make sure there's no issues with the lending. But we do a lot of lending laws. I just defer I'm not an expert in lending law, so we will always want to defer to the attorney, the real estate attorney or transaction to make sure that we're complying with whatever those are. But other than that, as long as it's disclosed, you could go either way. I don't think there's probably, I don't know if there's any cons of, I guess the pro is just cost, right? So the pro of doing it all in one offering is you just have one syndication and you're just paying it for once. And if you do a separate fund, then you're doing two syndications, right? So there's that's the thing, but I don't think it matters.
Okay, cool. Thank you.
All right, guys, I know I told Bethany we'd be out of here by the time. I didn't realize we were going to go this long, but I'm happy to keep going. But how many questions do we have?
50, 60 messages. I haven't read them all because I'm trying to go in order and I don't want to lose people.
All right, let's go.
Michael Evans has a question about joint ventures versus syndications, it sounds like.
Yep.
I don't know if Michael is on still. I can ask it real quick. So basically what he wants to know is, can a group of friends who are all active in the deal get together as investors? And if so, do they have to still file with the SEC for an exemption of securities registration?
I think the key point on joint ventures is understanding that you don't get to make that decision, right? It's either a joint venture, it's a securities offering, depending on how you've structured it, right? You just calling it a joint venture isn't going to help you. It's like, what exactly is going on? So yes, if you've got everyone in there is an active participant so that the returns are being generated by everyone's effort, not by one person's or, syndicators, or there's somebody who just wrote a check and went home, then as long as you not have too many people, once you get past 5, it gets tough, but let's just assume you have 5 or less. I wouldn't call them even investors. I would call them partners because you're really starting a business. But if everyone's actively involved and they all bring something to the table, then that would be a joint venture, and then therefore would not be a securities offering because there isn't one person who's generating the returns. But the biggest mistake I think I see is people calling it a joint venture when in reality it's a securities offering. And you can change your facts. So if I look at something and say, well, that's really a securities offering, you could change things up to make it a joint venture, but then typically that doesn't work if you're really trying to squeeze it in there, because you wouldn't have acquisition fees, you wouldn't have carried interest, you wouldn't have, if everybody's contributing, then you wouldn't have any of these. Those fees look like securities fees. But yes, if everyone's actively involved, then it's a joint venture and it's not a securities offering.
Excellent. Doug Smith. Doug, how's it going? Long time no see.
Hey, Bethany, how you doing?
Hey, good.
Hey, thank you so much for the call earlier today. That was very informative, and thank you, Mauricio, for these calls that you're doing every Wednesday. I'm getting a lot of value.
I appreciate that.
And I actually have a fund similar to the one you were mentioning just a second ago. It's a debt fund. It lends all the real estate deals I'm doing, so that's working out really well. I was wondering, I'm spending a lot of my time raising capital. I was trying to hire somebody to do them and then bonus them, but it sounds like that could be highly illegal. So I was wondering, do they need to get their Series 65 license to make that possible?
No, the only way you could do it, and I don't know, maybe it's Series 65, but you have to, you cannot pay an investment advisor either. You've got to be a broker dealer. So what happens is you can be and this has happened before. We've got plenty of people who've taken this route where you could become an investment advisor and then hang your license with a broker dealer. And so the commission is still paid to the broker, and just like a real estate arrangement where there's a real estate broker and a real estate agent that hangs their license, and so the real estate commission goes to the broker and it shares it with the real estate agent. It's the same concept. The commission goes to the broker dealer, and then the broker dealer has an arrangement with the investment advisor to split that commission a certain way. The challenge is always trying to find a broker dealer that's going to allow you to go, go raise money for something other than what the broker dealer is trying to peddle, right? Because they're usually a broker dealer's got their own products that they want you to go sell. But it is possible. We do have people who have found broker dealers who are willing to do that. But what I don't know, because again, it's not my area of expertise, whether a Series 65, that's the easiest one to get for sure. But I don't know if that's good enough to be able to then hang your license with a broker dealer and get compensated. But theoretically, some type of investment advisor license hung under a broker dealer would make it work.
Gotcha. And real quick, if I'm not able to make that work and I'm just paying certain people that are maybe on my staff to go have lunches and dinners with people, I'm paying them maybe $100 or $200 every time they have a lunch. And then I have it to where their pay per dinner, for example, keeps going up the better they're doing at raising capital. Is that
It's the same. It's the exact same rule. So one of the misconceptions is that somehow, an employee is different from a co-sponsor, which is different from a 10. It doesn't matter. We're all trying to fit into, let's break it down. We're all trying to break into what we call the issuer exemption. That's not really it's a 3-4A1. So anybody that's not the issuer, meaning the syndication LLC, the syndication LLC is raising money for its own account. So there's no broker dealer issues there. Generally speaking, if there's one person who is the sponsor, then that's also generally recognized that they're not raising money for other people. They're raising money for their own account. But the minute you have two people, so co-sponsors, then all those people are not the issuer, they're agents of the issuer. In this case, general partners, but they could be, like I said, an employee, or they could be an agent, whatever. And so in order for you, the exemption you're trying to fit into so that you're not considered a broker dealer is this issuer exemption, which means, again, no transaction-based compensation. So that's why what you said wouldn't work, because they're getting compensated more money, the more, maybe the more money they bring in, the better they're doing. That's transaction-based. That would be prohibited. They have to be involved in substantial duties. So this raising capital still has to be incidental to their business. I mean, they have a job and they're doing that job, and then part of the time they're maybe raising capital. That's fine, as long as they're not getting compensated for that part. And 3, the primary role needs to be those substantial duties. So when you have a person who's just, their sole job is to go find money, you can't bonus them on that. You can't, one of the things we're looking into is possibly bonusing them on how the company at large does. If you've got a large, operation, or, you've got the sponsor company or whatever that's making all the money on all of the deals. And then you're, just like any company will bonus their employees based on how well the company does. We're in the process of nailing that down so we can run it by Alex, to be honest with you, so that we can see, hey, here's what we're planning on doing. I'm trying to get his blessing on it. But they still have to be doing substantial duties. And more importantly, the big one is transaction based. The minute you tie compensation or bonuses to how much money they bring in, that's the death, whatever it's called, the nail, whatever.
Death nail.
That's the hallmark of broker dealer activity, is transaction-based compensation.
Gotcha. All right. Thank you. Appreciate it.
Great. Okay. Justin Smith, you've been patient. Thank you.
Thanks, Mark. I saw that at Wealth Forge will allow independent licensees to utilize them as a responsible broker dealer. So they're out there. Thank you, Mark.
Hey, this is Justin.
Hey, Justin, how are you, man?
I'm doing great, Mauricio. Great videos that you put out on LinkedIn.
Appreciate it.
So that's pretty cool. You're doing that, and Bethany, thanks for all your help tonight. My question has to do with either a fund or syndication, but having non-accredited investors that are also foreign, right? So let's say I have, because I'm dealing with that. I'm doing 506C raises for syndication. Obviously, I'm here and also listening to sort of this whole fund concept, and that's the next level I'm looking to go to. But I have a group of Israeli investors, right? And some of them are non-accredited. So I'd like them to invest, but it's a 506C offering, so maybe that doesn't work. But
I've got an answer I got a solution for you.
I'd like to hear your insight on that. Thank you.
So great question. There is a separate exemption that we don't usually talk about, but there's Reg A, which we I think know about, right? Kind of the mini registration. There's Reg D, which is the 506B, 506C, and to a lesser extent 504. And then there's an exemption called Reg S, as in Sam.
Reg S. Yep.
Reg S, and that's for international folks. So remember, the SEC doesn't really care about non-US persons or non-US citizens. So as long as they're not in US territory. So if you've got some investors in Israel, and they are not US persons, they're not US citizens, and they live in Israel, and they, at the time you sell them the security, are physically located outside of the United States, and they will fit into a Reg S exemption. So they can be non-accredited, because the non-accredited is the 506B, 506C, Reg D stuff, but that's not what we're using to bring them in. So the only thing the US really cares about is making sure that there are safeguards where you're not going to sell them securities outside of the United States, and then somehow there's a backdoor way they can resell it back into the United States. So there's some language there, but no, it's if you're doing one that has both, I would do a concurrent raise where we raise under 506, a Reg D and or Reg S. we'd put some disclaimers, obviously some language regarding Reg S. And if it's purely Reg S, usually then you don't even use a U.S. securities attorney. You primarily would use I mean, I don't know anything about the Israeli securities law, so you want to make sure you're complying with their rules. But usually at that point, you would just go hire an Israeli securities firm to do the raise over there, and then you potentially consult with somebody here. But most securities attorneys won't even handle. They don't need to. There's no regulatory compliance for us on this end if all of your investors are out there. The things you got to be cognizant of on a Reg S, or whenever you have international investors, is number one, you've got a tax withholding obligation. So anytime that you have to repatriate funds to Israel or any other country, there's a 30% withholding requirement that's on you. And that goes to it used to be the Treasury Department, but basically you withhold the 30%. It's not a tax, it's a withholding, so that theoretically your Israeli investors, if it turns out to be less than 30%, they can file a tax return and get a refund. But if you don't withhold the 30%, they've got zero incentive to file tax returns. And so you could potentially be on the hook for that tax if you don't withhold. So that's important to work with a really good CPA that understands cross-border transactions. And then the other thing that pops up, I don't know Israel at all, but just make sure they recognize LLCs, right? Because if you have company, like Canada, for example, I don't know if you have any Canadians on the call, but Canada does not recognize an LLC. So when you start selling LLC units to Canadians, their taxing authority defaults it to a corporation and they get double taxed. So you just got to be aware of that and got to make sure we're structuring it properly. If you have a lot of Canadian investors, we would just probably create an LLP, a limited liability, limited partnership here in the US. That's what they get. So in Israel, I would just caution to just make sure they know what an LLC is, because otherwise that could be problematic. But yeah, that's not a big deal at all.
And can that be done simultaneous, like doing a Reg S? Mm-hmm. Do a 506, C / fund and do the Reg S at the same time.
100%. We do them all the time. Actually, all the time. We probably do, I don't know, 10 of those a year or something.
Okay. No. Okay. And that was one of the things I heard kind of in the background. In both
I've got one of my favorite videos, by the way. I'm going to do a little plug for my YouTube channel. If you guys have found any value in this, and you guys go over to the YouTube channel and do a subscribe, I would really love it and appreciate it. There's a great video that I did, pat myself on the back. I was in New York on Times Square, and I banged out a couple of videos in New York, and one of them was on international investors, and I had a professional videographer with me, so I really liked that. 2 pieces on content. One was the Reg S, and the other one was actually joint ventures versus syndications. But yeah, if you guys haven't checked out the YouTube channel, I'd highly recommend it. I'm trying to put out as much content as possible, and these end up on YouTube. At least they have been. I don't know if they're going to keep going there.
All right, perfect. Thank you.
Thank you. Thanks, my friend.
I think we lost Yami. Everybody, we're going to be providing this recording for everyone. So let's answer his question and then tell him he can go listen to the recording.
Okay, sounds good.
So he's asking, what's the typical time to raise capital for a first-time fund? That's the first question. Any limit to the number of funds set up within a certain time period, or number of different GPs within different funds?
Let's take the last one first. It's another pet peeve of mine. Yeah. You don't want to have too many GPs, right? I mean, you run the risk of why do you need 9 GPs, right? Somebody in there is there to raise money, and that's what the SEC is going to look at. And so most of these things you can do with 2 people, maybe a third person gets brought in because they're boots on the ground, or they have some specific, gift that they can add. But once you start getting to 4, 5, 6, 7, we all know that they're getting brought in because they've got a big database and they can raise capital. And so I would try and limit the amount of GPs you have. And if you do end up with a large amount of GPs, I would highly, highly, highly recommend putting something together before the deal, some kind of an MOU that would outline what everybody's function is and what percentages they're going to get. I actually would have that notarized, even though it's not a legally binding document. Nobody can accuse you later and say, well, you paid this person more because they brought in more money, because this is all settled, ahead of time. And it's like, okay, Mauricio, you're going to go do this. And in exchange for that, you're going to get 12%. You're going to do this. And so, because the issue is, of course, that, they figure out those percentages at the end based on how much money they raise. So that one I've got strong feelings about. Bethany, say that again. What's the other 2? Oh, how long does it take? That's dependent on, we had a call with somebody today. I don't know if they're on the call. I won't mention his name, but they had the investors lined up. So as soon as we're done drafting the PPM and all those docs, they're going to be able to just send them out to their investors and probably collect everything in 5-6 days, right? If you have never raised money before and don't have a list, and hopefully it's not the situation where you find a deal and you're like, okay, I gotta raise $1 million in the next 30 days. What do I do? So you want to constantly be working and finding investors and networking. And it's the best time to find investors is when you don't have a deal. So this is the time you want to go to events and network and meetups and stuff and get into those conversations so that you establish those substantive relationships. So it's just, so the answer is I don't know. It just depends. Every syndicate will depend on how long it takes them to raise. My good friend, Ken McElroy can raise $30 million in 24 hours because he's got that reputation. He sends out an email and boom, he's done. We all want to get there at some point, but until then, it depends on your list, really, and your relationships. What was the last one, Bethany?
Let's see. I lost him. What's the typical time to raise capital for a first timer?
Yeah, that's the one I just answered. It depends. Sorry, what was the other one?
Any limit to the number of funds set up within a certain time period?
No, other than the fund of funds, right? So some of those fund exemptions limit you to, some of them are 5 funds total, actually, or 15. So, but if you're just doing a regular fund, there's no reason why you couldn't set up a bunch of them. But on the investment advisory part, some states, in order to fit to the exemption, want to make sure you're not doing more than 5 or 15. Like I said, Pennsylvania is 15.
Yes. Okay, we're almost done here. Unless anybody is raising hands. DD Stump is asking, do we know about the new K2 and K3 for taxes to track foreign investors? I think it's just a tip. It's helpful. DD, did I get that right?
Oh, do you know about the new K2 and K3 for taxes? Helpful for fund managers to know about. That's great. I did not know about K2 and K3 because one of the issues with international investors, obviously, is you're not going to issue them a K1. Obviously, their tax authorities don't know what that is. So typically, I used to live in Belize, so I used to deal with Belizean stuff. Typically, you're just sending them some sort of a P&L or some, audited, financials or something to prove how much, profit and all that stuff. So yeah, that's great. I'm going to make a note of that. K2, K3, because I want to get, we're going to have, hopefully I'll get Tom to come on. We get a good CPA to come on and talk about taxes, and maybe we'll talk about those then. So thank you for that. I didn't know that.
Awesome. Justin, do you have another question? I know your hand is up, right? Justin Smith.
Oh, no.
Okay.
Just not sure how to
that
get
was
it.
it, Mauricio. I don't see any other questions. If I missed anybody,
First of all, I
bring up
can't,
the list
there's still, when I started doing these, I was just hoping that it'd be more than 5 people on the call so that it would at least fill up my screen and something. And I literally thought that today's call would be less than last call because it's a very niche topic. So I really appreciate you guys spending time with us. I can't appreciate you guys enough. And the fact that there's still over half of you still here after almost 2 hours of doing this, I get a ton of energy from this. I know Bethany does too. So thank you so much. We will be sending out, once the replay comes out, which shouldn't take too long, I'll send an email. I just don't want to bug you guys too much with email. So I recognize you guys get a ton of emails anyway, but we'll send you the recording. And, next week, make sure you come in for Ashley, who's amazing. And then we'll keep doing these every week. So we're looking forward to them. We really love doing these. So thank you.
Yeah, be lots of fun.
Thanks, everyone.
Thanks, everyone.